Can Apple's monumental pivot to artificial intelligence redefine its powerful ecosystem? And can it justify that multi-trillion-dollar valuation, especially now with all this regulatory and competitive pressure? We're diving deep into that very question today. And, well, I can tell you right now, the answer suggests a world-class company, absolutely, but one trading at a premium leaves very little margin for error. Welcome to the deep dive. Today, it's a comprehensive investment analysis into Apple Inc., that's ticker NASDAQ AAPL. Our analysis is current as of July 2, 2025, and the closing share price was $212.44. Our mission, like always, is to pull out the most important nuggets of knowledge, the key insights from our source material, really helping you get informed quickly. Okay, so let's unpack this deep dive. We've structured it in two main parts. Part one, we'll lay the foundation. We'll look at Apple's core business, evaluate its management, and really dissect the financials, chapters 1 through 3. Then in part two, we shift gears. We'll cover market sentiment, the ownership structure, a pretty critical risk assessment, and finally bring it all together with our conclusion and outlook. That's chapters 4 through 7. Before we jump in, just a quick note, this deep dive is powered by the insights we bring you daily, so please like and subscribe to Stock Analytics AI. Our members, for just €4.99 a month, get priority deep dives on tickers. And listen, over the next few months, we're covering all of the S&P 500 stocks. Members get that exclusive priority access. But hey, if you just want a one-off deep dive on a specific stock, drop us a super thanks.
All right, let's kick things off. First section coming up. Chapter 1, the Apple ecosystem. A business analysis. So we're starting right at the heart of Apple, its business model. You often hear it described as a masterclass in synergy. What does that actually mean for you, when you're using your iPhone or your MacBook?
It means fundamentally that Apple's hardware isn't just hardware. It's the gateway. They design, make, and market these premium consumer electronics. But those devices then pull you into this ecosystem of software and services. And that's where the really high margins are.
Like a Trojan horse, almost.
Kinda, yeah. And they manage this globally, tailoring strategies for the Americas, Europe, Greater China, Japan, rest of Asia Pacific. Revenue mainly comes from two streams. Products, that's the hardware, the foundation, and services. Services is the key growth engine now. Fiscal year 2024, services revenue grew, 13%? Nearly hit $100 billion. It's huge.
Okay, so the hardware gets you in the door, the services keep you paying. What are the key products and services driving this whole machine?
Well, the iPhone is still, the flagship. Over $200 billion in net sales last fiscal year. The latest iPhone 16 series, specifically the base model, was the world's best-selling smartphone in the first quarter of 2025.
Still dominant.
Absolutely.
Yeah.
Then you've got Mac and iPad. They're increasingly powered by Apple's own silicon, the M-series chips. That gives them a real edge in performance efficiency. And now, especially with these new M4-based MacBooks, enhanced AI capabilities.
Right.
And then there's wearables, home, and accessories. Think Apple Watch Series 10 now, the Ultra 2 AirPods, and of course the Apple Vision Pro. That's their first spatial computer, a whole new category. But the really sticky part, the high-margin engine, is services. That's the App Store, Apple Care, iCloud, advertising, Apple Music, Apple Pay, Apple TV, plus Apple Arcade, Fitness Plus.
Yeah.
The list goes on. These services are just critical for their overall profitability. Very high margin stuff.
Clearly a global force. Just how dominant are they in these markets? And what's that unique thing, that value proposition that keeps people locked in?
Oh, they're incredibly dominant. Smartphones, they lead globally.
Yeah.
Over 25% market share as of June 2025, ahead of Samsung. Their PC shipments, Mac specifically, also saw really strong growth recently, like 17% in Q1 2025, especially in that premium segment where macOS holds about 15% share. And wearables, definitive leader in the U.S., a market projected to grow double digits for years. But the value proposition, it's not just market share numbers. It's that whole integrated experience. Seamless, secure, across all the devices and services.
The walled garden.
Exactly, the walled garden. It's elegant, user-friendly, big focus on privacy. And here's the kicker, right? The more Apple stuff you own, the more valuable each piece becomes because they all work together so well.
Creates incredible stickiness.
Massive switching costs, yeah.
Okay, that walled garden sounds like this amazing competitive advantage. But is it also maybe becoming their biggest vulnerability now? With regulators sniffing around? And what about the competition?
That's the core tension right now. The industry itself is moving fast, especially with AI integration, like processing directly on the device. Subscription services keep growing. And Apple still has this huge base, 2 billion active devices, that they can potentially monetize further through services. Plus, new things like Vision Pro, expanding in markets like India, lots of potential growth levers.
Right.
Competitively, sure, they face giants. Samsung, Xiaomi in hardware, Google, Microsoft in software and AI, Netflix, Spotify and services. But the biggest threat, fundamentally, is that intense global antitrust scrutiny. The EU's Digital Markets Act, the US DOJ lawsuit, they're aiming right at that walled garden.
So their strength is their weakness.
In a way, yes. It's fascinating because that ecosystem, that's their deepest moat. Their brand, their scale, the network effects. It would take tens of billions to even try and replicate it. Huge barriers to entry.
Okay, let's unpack that moat a bit more. What are the specific competitive advantages that really set Apple apart?
Number one is brand strength. It's consistently ranked the world's most valuable brand, allowing premium pricing and fostering incredible customer loyalty. Then cost advantages from economies of scale. They produce hundreds of millions of devices. That gives them huge negotiating power with suppliers. They use common components too, like chips across iPhone and iPad. But the most powerful advantage, probably the network effects and switching costs. We talked about the walled garden. Features like iMessage, FaceTime, AirDrop, Handoff, they work seamlessly if you're all in on Apple.
Right, leaving is painful.
Exactly. You lose that integration. It creates powerful lock-in. And finally, their unique capabilities. Designing and integrating hardware, software, and services like nobody else. Their proprietary silicon, the A-series and M-series chips, optimizes performance. And now, this big push into Apple Intelligence, their on-device AI. So what's really fascinating here is that tension we mentioned. The very ecosystem is their deepest moat. It's now their greatest vulnerability to regulators. The strategic shift toward services and AI. It isn't just opportunistic growth, it's becoming a defensive necessity, especially as the smartphone market matures and revenue growth slows down. Services with those superior margins are truly mission critical for future growth. That's a really powerful setup. Okay, moving on to how the company itself is run. Chapter 2. Management evaluation. When you talk leadership, Tim Cook's time at Apple, well, it's been extraordinary. He took them from, $348 billion to over $3 trillion? What's his track record like, and how have they handled crises?
Yeah, Tim Cook, since August 2011, his tenure has been defined by operational excellence and just unprecedented growth in value. His style is seen as more democratic, collaborative, systematic, compared to Steve Jobs. Makes sense, given his COO background. He's a master of the supply chain.
Right.
Under him, they've launched huge products, pivoted decisively to services, and really emphasized sustainability and privacy as core tenets. In terms of crisis response, they've evolved. They used to be incredibly secretive. Now there's generally greater transparency. Like in 2012, releasing their supplier list after the Foxconn pressure, they've shown resilience too, thinking back to near bankruptcy in the 90s. For technical crises today, their priority is customer protection, often waiting to disclose issues until a fix is ready. Apple projects this strong ethical image. Tim Cook often says, do the right thing. But does the reality always match the image? What about their transparency and ethical reputation day to day?
Publicly, absolutely. The commitment seems strong. Annual ethics training, focus on diversity, Fortune's most admired company year after year.
Yeah.
Cook reinforces that message constantly.
Right.
But there's this dichotomy. Watchdog groups persistently criticize their global supply chain. Issues like poor conditions, treatment of migrant workers, especially historically in China, now maybe shifting focus to places like India. They also get flack for complex tax strategies, routing profits through low-tax places like Ireland. And environmental groups sometimes challenge their carbon-neutral marketing claims, saying they're not fully transparent.
So a strong public stance, but some very real persistent challenges behind the scenes. Okay, let's talk money. Where does Apple put its capital? How do they handle investments, acquisitions?
They prioritize investing back into the core business. There's that huge $500 billion U.S. investment plan over 4 years. AI, silicon R&D, data centers, creating like 20,000 new jobs. Their R&D budget is massive, nearly $32 billion in FY24, up almost 5%, and a lot of that's going into AI now.
And acquisitions, they're not known for huge deals usually?
Historically, no. Very disciplined. They buy small companies, mostly for talent and tech, not for buying revenue streams.
Sure.
The biggest was Beats in 2014 for $3 billion. But there might be a paradigm shift happening. These exploratory talks to potentially acquire Perplexity AI for maybe around $14 billion.
Oh, wow. That would be huge.
It would shatter their record. It signals potentially a dramatic shift, driven by urgency in this generative AI race. Maybe they feel they need an in-house search alternative to that big Google partnership. And maybe their traditional build-it-yourself approach is just too slow right now.
That's fascinating. A potentially massive strategic change. What about returning capital to shareholders? They're famous for buybacks and dividends.
Oh yeah. They run the largest share repurchase program in corporate history. Over $600 billion bought back in the last decade alone. That's reduced the share count by, what, almost 38%. It's a huge driver of earnings per share growth.
Right.
They announced another $110 billion authorization in Q2 2024, then another $100 billion in May 2025. They're spending billions on it every quarter. And dividends. Regular quarterly payout increased for 14 straight years now. It's currently $0.26 share quarterly. And it's incredibly safe. The payout ratio is only about 16%. Loads of room.
And that efficiency metric, how good are they at generating profit from the money they invest? Return on invested capital, ROIC.
ROIC as well. It's astounding. For the 12 months ending March 2025, it was 61.5%.
61%.
Yep. And it's averaged around 47% over the last 5 years. That just vastly outperforms peers. And if you connect this back,
Yeah.
this phenomenal ROIC is really the justification for that huge buyback program. They generate way more cash than they can realistically reinvest at these incredibly high rates of return. So logically, giving that excess cash back to shareholders through buybacks makes perfect sense. It's value accretive. The high ROIC fuels the buybacks boost EPS. It's a powerful cycle.
That really connects the dots. Okay, clear picture of management and capital. Let's get into the numbers themselves. Chapter 3, financial analysis. Let's dive into the core metrics. Market cap, revenue trends, those really impressive profit margins.
Okay. Market cap, as of early July 2025, roughly $3.17 trillion. Revenue growth, though, it's moderated quite a bit. Peaked over 33% back in fiscal 21. Actually contracted slightly in 23, recovered a bit in 24. The 5-year average is around 9%. This really highlights why that services growth is so crucial now.
Right, the hardware growth is slowing.
Exactly. But profit margins, exceptionally strong, very stable. Gross margin is near 47%, 47.1% most recently. That's heavily driven by services, which have margins over 70%.
Wow.
Operating margin around 31%. Net profit margin consistently in that 24-26% range. It was basically 26% in the March quarter.
Yeah.
And the cash flow, just an unparalleled cash machine, consistently generating $100 billion or more in free cash flow annually. FY24 was almost $109 billion. That gives them immense flexibility.
Those are really robust numbers, especially that free cash flow. What about stability indicators? Earnings consistency, debt levels, current ratio.
Earnings consistency has been remarkable over the past decade. Diluted EPS grew from under $3 in FY18 to over $6 in FY24. And again, buybacks amplify that growth significantly.
Okay.
Debt to equity, it's around 1.45. Now, that might look leveraged, but for Apple, it's a deliberate strategy. That debt is easily covered by their cash flows. They use it because debt is cheaper than equity, helping optimize their cost of capital, especially for funding those buybacks.
Interesting. What about the current ratio? I saw that was below 1.
Yeah, it was 0.8x as of March 2025. That's below the typical healthy range of 1.5 to 3.0 you might see cited.
Yeah.
But, and this is a crucial distinction for Apple with their predictable, massive cash generation, this is not a sign of financial distress.
Okay.
It actually reflects incredibly efficient working capital management.
Mm.
They simply don't need or want a lot of cash just sitting idle on the balance sheet, not earning much. It's a kind of financial engineering that's only possible for companies with such strong profitability and cash flow. Use cheap debt, keep working capital lean, boost returns.
Got it. So don't panic about the low current ratio in Apple's case.
Exactly. And their dividend. Model of stability. 14 straight years of increases, consistent growth around 5%, and that super low payout ratio means it's exceptionally well covered. Very safe.
That's a vital distinction for understanding Apple's finances. Okay, finally in this section,
Well,
valuation. How's Apple valued today compared to peers and maybe its intrinsic worth?
relatively speaking, Apple trades at a premium. Its price to earnings, or PE ratio, is currently in the low to mid 30s. That's higher than its own 5-year average of around 28-29x. It's higher than Google or HP, maybe slightly lower than Microsoft recently. The market sees it as this high-quality hybrid, part hardware, part software services.
And what's the risk there?
Well, what's fascinating, or maybe concerning, is that this premium valuation suggests the market is already fully pricing in perfect execution ahead, especially the successful large-scale rollout of Apple Intelligence. With hardware revenue growth slowing, if the PE multiple is expanding, it means the market is giving Apple full credit in advance for its AI strategy working brilliantly.
Sets a high bar.
It creates significant valuation risk. There's very little margin for error if Apple Intelligence disappoints or if services growth stalls.
Okay, and intrinsic value, like from a discounted cash flow model.
Right, a DCF tries to estimate intrinsic value based on projected future free cash flows, discounted back to today. Highly sensitive to your assumptions, of course. Academic models show a wide range, maybe $178 up to $287. Our own educational DCF model, based on reasonable assumptions like mid-single-digit revenue growth tapering down and a discount rate around 8.5, 9.5%, suggests a value somewhere in the $185 to $205 per share range.
Okay, so trading a bit above that estimated range right now.
Seems that way based on this particular model, yes.
All right, we've built a strong foundation on the business, management, and financials. Let's shift focus now to what the market is actually saying about Apple. Chapter 4, Market Sentiment. So what's the general feeling on Wall Street about Apple right now, analyst consensus, and how's the media portraying them in 2025?
Wall Street sentiment is broadly positive still. The consensus rating is generally a buy or strong buy, but there's a wide dispersion in price targets, anywhere from maybe $140 up to $300, and the average 12-month target sits around $238. That implies, moderate upside, maybe 12% from the current $212 price.
Okay, and the media narrative?
It's pretty mixed, actually. The bullish side focuses on the strength of high-margin services, App Store revenue growth still looking solid, maybe 11, 12% year over year. There's speculation about AI partnerships. That huge $500 billion U.S. investment plan gets good press.
All right, the bearish side.
That focuses on the dead money narrative, how Apple stock underperformed other big tech names in the first half of 2025. There's intense focus on the regulatory scrutiny, both U.S. and EU. And that looming threat of U.S. tariffs on Chinese-made goods is a big cloud.
Okay, beyond the headlines and analyst ratings, what do the hard market indicators, short interest, moving averages tell us about investor conviction, or maybe the lack of it?
Short interest is extremely low, like 0.67% of the float. That tells you there's virtually no significant institutional money betting against Apple right now. The market, in aggregate, isn't bearish. From a technical chart perspective, the price recently broke decisively above its 50-day moving average. That's usually seen as a bullish short-term signal. But the longer-term picture, using the 200-day moving average, is more cautious. For a good chunk of 2025, Apple was actually one of the few Magnificent Seven stocks trading below its 200-day MA, signaling that relative underperformance we mentioned.
So what's the takeaway from those indicators combined?
What's fascinating is how they paint this picture of, well, maybe a coiled spring. The stock underperformed, but it didn't lead to big bearish bets. Short interest is super low. Analysts are still bullish overall. It feels like many investors are in a wait-and-see mode. They're not selling out, but they're hesitant to chase the price higher without a clear, positive catalyst. Maybe waiting for AI news or tariff resolution.
Tense anticipation.
Exactly. It creates a market where significant positive news could trigger a sharp move up, but negative news could break the stalemate downwards. It's anticipation, not outright bearishness yet.
Okay, makes sense. Now, who actually owns all this Apple stock? Let's get into that. Chapter 5. Ownership structure. Apple is, it's a core holding for institutions everywhere. Who are the biggest players? And what about insiders? Are they buying or selling?
Yeah, the ownership is heavily concentrated among the very largest asset managers. Think Vanguard, BlackRock. They hold huge chunks, maybe 8.5, 8.8% for Vanguard, around 7% for BlackRock. A lot of this is because Apple is such a massive component of passive index funds, like S&P 500 trackers.
Yeah.
So State Street, Berkshire Hathaway, Fidelity, FMR, Morgan Stanley are also big holders.
So lots held by funds that have to own it.
A significant portion, yes, driven by index weighting. Insider holdings, on the other hand, are minimal, like 0.06% of the company. Top individual insiders, Arthur Levinson on the board, Tim Cook, they hold millions of shares personally, sure. But if you look at recent transactions, 0 reported insider buys in the past year.
0 buys.
0 reported buys. What you see is program selling, which is pretty typical for executives managing compensation, diversifying, covering taxes. The only notable recent purchase flagged was actually by a member of the U.S. Congress.
Interesting. So mostly institutions and the public, very little insider ownership percentage-wise.
Right. Institutions hold just over half, about 51%. The public and other companies hold almost 49%, and insiders that tiny fraction.
Right.
And if we connect this back, a crucial aspect here is what you might call the passive moat.
Passive moat.
Yeah, that heavy concentration in passive index funds creates this incredibly stable, long-term shareholder base. These funds must own Apple according to its index weight. This provides a constant structural source of demand for the stock, which can dampen volatility and buffer against panic selling during downturns. It's a structural advantage, separate from the business itself.
Huh. Never thought of it that way. A passive moat. Okay. Now, every investment has risks. Let's get into the comprehensive risk assessment. Chapter 6, Risk Assessment. All right, first up, can you give us the SWOT analysis breakdown? Strengths, weaknesses, opportunities, threats.
Sure. Strengths. World's most valuable brand, huge financial resources, over $160 billion in cash, that deeply integrated ecosystem creating high switching costs, strong innovation like their custom silicon, and that growing high-margin services revenue stream. Weaknesses. Those high selling prices limit the total addressable market. They're still heavily dependent on the iPhone for revenue, which is a concentration risk. Some argue their distribution network could be broader. And there's that perceived lag in generative AI compared to some rivals.
Okay, opportunities.
Opportunities. Leading consumer AI with Apple Intelligence, emphasizing privacy, continuing to grow services, monetizing that massive 2 billion device installed base, expanding it to new categories, Vision Pro, maybe automotive down the line, deeper penetration in emerging markets, particularly India, and potentially expanding distribution channels.
And the big threats. Aggressive competition, obviously Samsung, Google, Microsoft. That intense global regulatory pressure we discussed, targeting the walled garden. Geopolitical tensions and supply chain risks, mainly centered on China reliance, imitation by competitors, and potentially rising labor costs in manufacturing hubs.
That lays out the landscape well. Let's double-click on a couple of specific threats. Macroeconomic factors like inflation or interest rates, and those geopolitical risks like the China tariffs. Okay, macro factors. Inflation. Well, persistent inflation could erode consumer spending power. That might lead people to delay upgrading their expensive iPhones or maybe switch to cheaper alternatives. Though statistically, the correlation with net income is a bit spurious, likely not causal.
Right.
Interest rates are a clearer dual threat. Higher rates increase the discount rate used in valuations, which mathematically lowers the calculated intrinsic value of the stock. Plus, higher rates make borrowing more expensive for consumers, discouraging spending on big-ticket discretionary items like, well, iPhones and Macs.
Okay, and the geopolitical angle, specifically those potential U.S. tariffs on Chinese goods from 2025.
Yeah, that's a major overhang. The specific threat is a potential 25% import tariff on smartphones manufactured in China, which is clearly aimed significantly at Apple. We'll likely get more detail on the potential impact when Apple reports its Q3 2025 results at the end of July. Previous estimates suggested maybe a $900 million hit to earnings if it was fully implemented.
How are they trying to mitigate that?
It's a massive, long-term effort to diversify the supply chain away from China. The most visible part is the rapid expansion of iPhone production in India. Foxconn is investing heavily there. Projections suggest India could be assembling maybe 25%, even 30% of all iPhones by the end of 2025.
That's a big shift.
It is. It provides a partial shield against China-specific tariffs. But it also highlights the immense complexity and cost involved in shifting such a sophisticated supply chain. And what's really fascinating, or maybe concerning, here is how that relationship with China has flipped. It used to be this incredible symbiotic advantage, huge manufacturing scale, massive market access. Now, it's arguably Apple's single greatest geopolitical liability. They're caught right in the middle of U.S.-China trade tensions. Tariffs directly threaten their cost structure. This forced diversification to India, Vietnam, elsewhere. It's a monumental, expensive undertaking. A key historical strength has really transformed into a major source of risk and uncertainty.
A huge strategic challenge for them. Okay, we have covered a lot of ground. Let's bring it all together now. Chapter 7, conclusion. Based on everything we've talked about, the business, the management, the financials, the market, the risks, what are the core arguments for and against investing in Apple right now? The bull and bear cases.
Okay, the bull case rests on several pillars. First, that seemingly impenetrable economic moat, the brand, the scale, those powerful network effects creating high switching costs. Second, it's a financial superpower, generating over $100 billion in free cash flow annually with that exceptional 61.5% ROIC, just incredible financial strength. Third, their capital allocation is extremely shareholder-focused, massive buybacks driving EPS, a very safe and consistently growing dividend. And fourth, the AI opportunity. Apple is uniquely positioned, arguably, to deploy personalized, private on-device Apple Intelligence across its enormous 2+ billion active device base. This could deepen the moat further and potentially unlock the next major growth cycle for them.
Okay, sounds compelling. What about the bear case?
The bear case focuses on significant headwinds. First, that regulatory siege. It's unprecedented global antitrust pressure aimed right at the core walled garden from the US DOJ, the EU's DMA. This poses a fundamental threat. Second, geopolitical and supply chain risk. That heavy reliance on China is now a major liability due to trade wars and potential tariffs, forcing that complex and costly diversification. Third, the valuation. As we discussed, the current share price seems to imply perfect execution on AI and services growth, leaving very little margin for safety if things don't go exactly to plan. It's priced for near perfection. And fourth, lingering innovation and growth concerns. The smartphone market is largely saturated. There's that perception they lagged in the initial generative AI race, making their current catch-up effort potentially risky.
Okay, summing up the valuation picture then.
Right. Our educational DCS model pointed towards an intrinsic value range of roughly $185 to $205 per share. With the share price at $212.44 as of our analysis date, it seems to be trading at a slight premium even to the upper end of that estimated intrinsic value range.
So for our final thought for you, the listener, considering all of this, what's the concluding outlook on Apple at this moment?
Look, Apple Inc. remains an exceptionally high-quality business. It has a formidable economic moat, outstanding profitability, strong management, no doubt about it. However, at its current market price, around $212, it does appear to have fully priced in not just these existing strengths, but also the successful execution of its very ambitious AI-driven initiatives. So for a value-oriented investor, someone looking for a significant margin of safety between price and estimated value, the stock probably doesn't offer that right now. Future returns from this point will likely be very closely tied to Apple's ability to actually deliver on the market's already very high expectations. The question for you to really mull over is, are you comfortable owning a world-class company where the market seems to have already factored in perfection? Or does that premium leave too little room for the inevitable bumps and challenges that lie ahead?
That's the key question. So as you consider Apple's future, think about that core tension. Its greatest strength, that integrated ecosystem, is simultaneously its greatest vulnerability to regulators right now. And that big, bold AI bet. It feels like a necessity for future growth, not just a new opportunity they're chasing. What stands out most to you about Apple's position in this complex moment? We really hope this deep dive helped you unpack Apple Inc. If it did, please like and subscribe to Stock Analytics AI for more in-depth analyses just like this one. And remember, our 4.99-month members get priority deep dives on tickers. We are covering all of the S&P 500 stocks over the next few months, and members get exclusive priority access. If you just want a one-off deep dive on a stock you're interested in, drop us a super thanks. And one final, very important note. This analysis was generated by an AI system purely for educational purposes. It should absolutely not be considered financial advice. Please, always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions. Thanks so much for joining us for this deep dive.